All right, joining us now on Market Banter is Julian Koski. He is the co-founder and chief investment officer at New Age Alpha. Julian, thank you so much for being with us on Market Banter.
Yeah, pleasure. Great to be here.
No, the pleasure is all ours. And I think this is the second week in a row where we've had just the perfect guest for what's happening in the market right now. Talk to me, just explain a little bit to me and to also our viewers and listeners what New Age Alpha is. You've got the thing you call the human factor. Walk me through that.
Sure. So basically, we believe there's an epidemic failure within asset management and their understanding of risk, right? Portfolio managers think in terms of picking winners, where really when their goal should be to avoid losers, right? If you drew a straight line and that straight line was the S&P 500 and you ask an audience of portfolio managers, how would you design a portfolio to beat the S&P? 99% are going to say pick the winners. But think about this for a moment. In order to pick a winner, you have to have some knowledge of the future. And the future, as we all know, is unknown. And the more you forecast this unknown future, the more you're just increasing the odds you're going to be wrong and invest in a loser. So at New Age Alpha, we completely redesigned the investment methodology around avoiding losers, and we've divorced ourselves from traditional portfolio or Wall Street things, and we've adopted the principles from insurance to do that, right? So that's what we've done. It's all about avoiding a loser. We're not interested in trying to find who the next winner is. And the problem that comes is, what's happening in Wall Street today, it's not just Wall Street, it's everywhere. You look politically, what's happening. There's so much vague and ambiguous information out there that investors, humans, are impounding this information into stock prices. Now, that's what's leading to loss, right? You don't lose money because the fundamentals of the company are a problem. You lose money because of human behavior around the stock price, right? So humans, you just look at GameStop and look at some of these stocks going on. It's not, the fundamentals are bad to start with, but really what the problem is the behavior around it is even worse, right? And that's the key. If you want to make money, there's a difference, investing versus gambling. We're investors, we're not gamblers, right? And we're calculating the odds that investors are viewing these stock prices incorrectly, right? It's mispriced odds. That's how you make money. You don't make money from the fundamentals.
So Julian, would you say that means that they're undervalued or overvalued in terms of like a pricing mismatch?
Which stocks are you talking about? Particular stocks?
I'm just saying generally, like from what you were just saying about like.
We're looking to avoid overpriced stocks and invest in underpriced stocks, right? And what an overpriced stock is a stock that has been pushed up by humans, by human behavior, that has no more relevance to its underlying financial statements. And we can calculate that mathematically. So what we do is we're using math here all the way. So we can see when humans are impounding vague and ambiguous information into a stock price. If you want an example, we can use Tesla, right? I mean, it's a good example of,
Tesla.
Well, look at Tesla from about 18 months ago. I want to go back in time. Tesla was trading at $253 about in July 2019, right?
Right at the bottom, we're talking about the bottom.
We did the math on Tesla. If you worked backwards from Tesla, you could calculate how many new cars Tesla needed to sell to justify that price. You could also calculate the revenue they needed. They needed $6 billion in revenue, and they needed to sell 95,000 new cars per quarter to justify that $253 price. Now, if you did a simple exercise, just open Tesla's financial statements to the prior 16 quarters to see how many times they actually delivered that, you would have seen they delivered that nearly 80% of the time. Now, let's put some context around this. Back then, there were 169 headlines about Tesla out there. 130 of those headlines were negative. You had Wall Street gods like Jim Chanos and David Einhorn all saying this company is the biggest short, it's going to go out of business. But that's the vague and ambiguous information I'm talking about. That found its way into the stock price. And in that case, it underpriced the stock. It was clearly underpriced. But it was just coming from vague and ambiguous information. No one did the math to look at, wait a minute, 80% of the time you could deliver.
But Julian, what about Tesla at $850 or $900 a share, where it is now?
Well, guess what? Right now, the probability of delivering is no longer 80%. It's only 50% now. It changes every day. Remember, the higher the stock price goes, the harder it becomes for management to deliver. Remember, that's what stock prices do. What everyone forgets to remember is, as you buy a stock and the stock price goes up, you just put more pressure on management now to deliver growth. To support that has to happen. Now, the key is, if it goes up too much, well, guess what? At some point, the company can't deliver anymore. You're going to have a failure on your hands. That's what we do in real time with math. We're doing what insurance companies do, right?
Well, so when you say insurance companies, you mean like from almost like an actuarial standpoint? I mean, explain that a little bit, yeah.
Well, we have a saying, manage risk like an actuary, not like a portfolio manager. Think about when you got life insurance, if you ever bought it, or health insurance. When you fill out that form, they don't ask you questions like, are you going to go to the gym? Are you going to quit smoking? They ask you very factual questions. Do you smoke? Do you not smoke? Do you go to the gym, right? They underwrite risk based on what they know. When we think about stocks, right, and underwriting risk, there's only two things you know about a stock at any point in time: the stock price and the financial statements. The rest is this vague and ambiguous information. The so-called gurus and forecasters, because that's what they're doing. They just, when somebody makes an assumption about the future, you're gambling. You're gambling. There's no other way to talk about it, right? So you want to do the math that strips out that gambling nature, to look at the company without that gambling aspect in it. That's all it is.
But I want to take you to another place here, because we are dealing with a lot of outside forces. I mean, you've got right now just a rising tide really lifting all boats, right? So it's like in this market right now, it's very hard to miss on stocks, whether they're properly valued or undervalued or overvalued, just because you've got the Fed pumping the market full of liquidity. You've got, this general bullish narrative that's going through Wall Street right now. So I think I would point out that there are a lot of stocks that really aren't, let's say, properly valued or are overvalued, but that continue to go up. Or would you say that's incorrect?
No, that's true. But again, that's where it's important to have something like what we do, right? Because stocks are going up all the time, and you want to differentiate between what we call fairly priced stocks, which we avoid. You're not interested in buying a fairly priced stock. There's no advantage there. You want to buy an underpriced stock, and you want to short an overpriced stock, right? So you want to look for the outliers, right? So right now, give you an example. The median probability right now of the S&P 500 is at about 50%, which means literally half those companies are fairly valued right now. But there's lots of outliers between that are overpriced and underpriced. And that's what you want to focus on. So you make money that way. You can't stop investing, right? The key is to know what you're looking at. It's mispriced odds. If you view the stock market as a casino, then somebody needs to have the odds somebody else is wrong. And that's what we're doing. Look, the fundamentals are important, but the fundamentals don't lead to overpricing. It's human behavior that leads to overpricing.
Sure. But what about, you talked about Tesla, right? So Tesla at 253 was undervalued. But what about Tesla at 400, 500, 600? It might have been, it was what?
Well, so as it grew up to its current value.
Well, no, again, as it was at 400 or 500 or 600, right? Because now it's over 800. Yeah. So even at those points, you had obviously gone down from 80% probability of delivering at those price points.
Yeah, but it doesn't drop that much. Doesn't drop that much. And one of the things people forget is, I'll give you another analogy to that, to think about Google. So we looked at Google 12 years ago when Google was just going public and things like that, right? And it was very interesting to watch Wall Street analysts tell you that at $500 a share, it was a buy. At $600, it was a hold. And they had all these different ideas when you should own the share. The fact of the matter, Google's stock price implied a certain number of clicks that if you went from $500 a share, it implied, I think, about just over 1 billion clicks, advertising clicks. At $800 a share, it implied something like 1,100,000 clicks, not that much more. Why? Because the margins that Google makes on that business doesn't impact the volume that they need to achieve. It's the margins are good. And Tesla's the same way. Tesla is unlike other motor car manufacturers. At each vehicle that it's producing, its margins are good and getting better. Right? So they don't have to sell many more cars as their price goes up. Yes, it's substantial now. It's gone from 95,000 new cars to 216, around about there, 216,000 new cars per quarter now. So now that's why it's moved into the fair value territory. And if you just looked at the announcement about a week ago, they pretty much hit that. That's exactly what they hit.
Okay. So let's talk about some of these meme stocks, as they're being called, that are in the news right now. You look at GameStop, you look at AMC, You look at Nokia. When you look at those seem to be moving completely divorced from fundamentals. But how do you view those?
Same way. I mean, I looked at GameStop, I think last Thursday. GameStop's probability of failure to deliver was 100%. Now, let me give you some context for that. We have never, ever had a stock in our system that gives you a 100% chance of failure, because we cap it at 99. So, because we just thought, wait a minute, it's not possible. It had a 100% chance of failure, right? I mean, again, are you a gambler? Are you an investor? You know, I mean, if you want to play the game of the GameStops and the AMCs, good luck, right? But it's dangerous, right? It's good and it's dangerous, right? There's one way to make money in this market. Don't lose money, right? Avoid the losers, right? The key is to avoid loss, right? And if people just understood that, you'd make a lot more money consistently versus, you know, yeah, great, you made a lot of money on GameStop. I promise you at some point you're going to pay the piper and pay that all back.
Yeah. What about some of these stocks that are picking up a lot of steam or getting talked about? Clover Health and Churchill Capital. What do you make of those?
Well, Clover Health, right? Let's just look at that one for a moment. I mean, I said earlier, and this one, Clover Health, actually, you know, corrects me quite a lot, because I said you don't lose money because of the fundamentals. But the problem is with Clover Health, you're losing your shit because of the fundamentals, right? It's, you know, the fraud and all those. So, you know, it's not... You know, it's one thing to say what I said, right? But the fact of the matter is, if somebody wants to perpetrate a fraud, well, that's a fundamental problem, and you're going to lose money, right? On that stock, right? So that's, you know, when we look at our system, we don't, you know, we don't work in that world. We work in the S&P 500 or to 2,500 more established names. We're trading with those. But, you know, again, it's, you know, one of the things about investing in the equity market is, in some respects, a lot of the risks investors take is an unpriced risk, meaning they don't get rewarded for taking that risk. There's no upside to the risk, right? But they take it because it might be the endorphin rush they get from what they do, but it's not about getting payback. At least if you go to a casino, you know the odds of being right and wrong. You know them. But when it comes to investing in stocks, you don't know the odds, and there's no pricing mechanism for it, right? If Warren Buffett was selling that Clover, is it called Clover Medical, right? You know that Warren Buffett would have done a lot of due diligence around it, and if he gave you a stock tip, you basically could expect to get a rate of return just north of the risk-free rate. Why? Because Warren Buffett is more right than he's wrong, right? Because he does the work to do that.
He's got a reputation up.
Right. But when somebody's telling you to buy Clover, or what Clover, is it called Clover again? Sorry, the name.
Yeah, Clover Health.
Clover Health.
Hindenburg came out with a note about it today, saying that they're shorting it, it's a fraud, et cetera, et cetera.
So if the person telling you about that is right only 50% of the time, well, there should be a discount for the price you pay for Clover for that guy being wrong 50% of the time. But there's no discount for it, right? So you're taking a risk where you're only betting on the upside, not on the downside. I mean, a simple thing I used to say to people is, if you go to the top of a mountain and you're going to ski down a mountain, right? And you go down the mountain and you break your legs, right? Well, you'll know the risk you took the minute you go down that mountain, right? But if you went to the top of the mountain and the insurance company puts a sign up there that says 80% of the people who go down this mountain break their legs, you will reprice your risk right there and then, right?
Yeah.
And that's the problem. There's no mechanism for investors to price the risk they're taking when they get into these stocks. Our human factor calculation is that mechanism. I'm telling you what the risk you're taking is, their price to be paid for this.
Okay. And Julian, last question I asked, because we gotta jump in and let you get back to, you know, pricing these stocks. But what do you think, if you could give me a couple names of the stocks that are the most detached from value, in terms of what's the most overvalued and most undervalued that you're looking at right now?
Well, when you look at, looking at names we know. Yeah. No, you look at Boeing. You look at Boeing for a moment, right? Even Boeing right now is a very overpriced stock, right? Because people are viewing that, and that's why I want to give you names that mean something, right? So Boeing, in our view, has about an 80% chance it's going to fail to deliver the growth that's implied by its stock price, based on math, right? And then you look at stocks like, Darden Restaurants, you look at Facebook, Goldman Sachs. These stocks are underpriced in our view, right? They've more than delivered just support the prices they're trading at. One would argue that they're actually they're very undervalued stocks.
Interesting. And the actual last question I'll ask you is just, does value mean anything? Because at this point, with, like I said, the Fed pushing up, pushing out liquidity, with stocks just kind of going out, does it really mean anything if a stock is over undervalued, if the price is just going to rocket higher anyway?
Right. I was going to say that too. It's like, it's because people are gaming the system anyway. And so if you're an investor and the shock shoots up, even if it's on shaky ground, like you were saying, who cares if I'm getting a massive return, right? I mean,
but at some point, you're going to pay. At some point, you're going to pay for that, right? And so that's it. If you want to take short-term returns and gamble on it, great, go ahead. But if you want to make a consistent return in a portfolio built to be sustainable, then no, you can't do that, right? Then you've got to look at it. That's what it is.
Okay. Julian Koski, co-founder and CIO, New Age Alpha. Thanks again for being with us.
Oh, thanks. It was great, guys. Anytime.
Great, man. Yeah.
Okay. Pleasure.